Again, everybody, welcome back for our first panel of the conference. I'm very excited to say that we've gathered an excellent group of thought leaders, chief executives from across the industry who will weigh in on the future of this industry, particularly as it has to do with ongoing opportunities, changes, and challenges that came about as a result of the COVID-19 pandemic. We have our wonderful moderator here with us today, Andrea, Badiola, Mateos, who's the head of the Finance Magnates group in Cyprus. Our panelists today will introduce themselves in just a moment, but I'll give them a brief introduction now. We have Marc Burki, the CEO of Swissquote Bank, Benjamin Bilski, the founder and CEO of NAGA Markets, Jonathan Brewer, the managing partner at IS Prime, Mohammad Isbeer, global head of brokerage sales at Equity Group, Matthew Maloney, CEO of Finalto, and finally Kypros Zoumidou, CEO of Brightpool. Let's give them a warm welcome. Thank you.
Thank you, Rachel. Welcome, everyone. Welcome to the very first panel of this iFX EXPO. We have a wonderful set of panelists here and a very short time to ask them everything we want. So I'm going to try to keep it straight to the point. I'm going to ask you to do the same. Yes, one more. Over there, please. Can you pass it over? Thank you. So we will have a set of questions, and then at the end we will open the floor for questions from the audience. We'll do a little Q&A. Like I said, we're limited to 45 minutes, unfortunately, so let's hit it. So my first question is on the topics of the boom that we have seen on trading volumes in the last year or so. So I'm going to start with Benjamin. So Benjamin, you mentioned earlier this year to us, Finance Magnates, that the rapid growth in your revenue was all a question of marketing, brand awareness, and ensuring that our systems scale. Following the boom in the trading during the pandemic, have you modified your marketing strategy? Was there any adjustments to do that have continued to your continuous growth?
Yeah, hi everyone. My name is Benya. I'm the founder of CEO of NAGA. NAGA is a social investing network. It's very important to mention that because we're not doing a classical brokerage. And what we've seen after the pandemic was a lot of awareness in social media and trading as a concept. And we've seen this as well in a lot of interest in the market, new users coming into the market. Everyone who sat at home was about trying to understand how to make money online. And they understood that trading is one way, right? So obviously, for us as a brand, we were prepared before the pandemic for such an, let's say, paradigm shift of user behavior. So we didn't modify it a lot. We just were there in terms of making sure that people understand what we offer to capture all the demand. And yes, you have to be scalable as a concept, but scalability is very broad. You just need to make sure that you're very stable. We have seen a lot of growth. We grew by hundreds of thousands of users. Also in revenue, we quadrupled in 2020. We doubled in 21 now. So obviously, I think it's more of a shift of user behavior rather than just the pandemic itself. I was very pleased to see that we are at the stage where the young users and the digital natives and the millennials come into the marketplace and understand that investing is not only for professionals. And I think if you're there with your brand and you can capture that, you'll be successful. And this is where we were. But we didn't change it a lot. We just made sure that we can cope with the whole traffic increase. And I think we did that quite nicely.
Thank you, Benjamin. That was quite a challenge, I guess, for everyone to adjust to a huge increase in volumes, etc. It has been touched upon in the last few months over different expos. So, Jonathan, have you seen any trends in broker profitability?
Well, since the pandemic, there have been kind of really two major trends that we've noticed. Obviously, the pandemic was a massive volatility event. It was a massive. There was a huge spike in brokers' P&L as a result of the initial sort of aftershock of the pandemic, and there were broadly sort of two camps that we observed within, let's say, the mid to smaller size brokers, which was one, a few brokers looked to take advantage of that big spike in their revenue to potentially try and exit, so to potentially try and sell their businesses at a good valuation. And I think that broadly, the observation from the market was that actually brokers that have highly volatile, very risk-based revenue profiles don't necessarily command a large valuation premium from the market when acquirers are potentially buying them. And then I guess the second observation, which is potentially more pertinent, is that immediately after a large sort of risk-based event that caused a huge amount of profit, you often have a situation where brokers somewhat reprice risk, so and arguably underprice risk. So obviously, a lot of brokers made a huge amount of money. So there's, let's say, more capital to put at risk. So a lot of these brokers took on a lot more risk, and then subsequently there hasn't been a huge amount of volatility, particularly in the FX markets, since the pandemic. Which has actually led to it being quite a difficult environment for retail brokers, particularly guys who are running a large B book, to actually make money and in some cases make ends meet. So there's been a sort of inflation in costs, an inflation in risk appetite, followed by a very difficult risk environment. So we found that there's now a situation where there are a lot of brokers that are seeing increased volumes, but actually really struggling to monetize their flow and really struggling with the kind of, let's say, the yo-yo effect of running a very large risk book. And I guess just the sort of broader market dynamics have caused that to be a much more concentrated and much more difficult problem for a lot of retail brokers.
Yeah, there has been quite a few challenges indeed. And the next question is actually related to that. It's more on an institutional level of things, so more directed towards Marc, Kypros, and Mohammad. So as market makers or providers of liquidity, how much of an impact has the retail traded volume had on your operations as providers of liquidity? And what kind of measures did you put in place to cope with all of these?
I'm happy to
Go
take
ahead.
some of that.
Go
Just
ahead,
a comment on the previous point. I think it's an interesting point you raise about the retail brokers and the situation they're in. But I think it's a key thing to think about is, we talk about this industry as FX, but retail brokers and FX is not exactly the same thing. It depends on the asset classes that you're providing to your clients. So I think over the past year or so, we've seen people that have equities as part of their product offering have a very different experience to people who have only FX. And so if you look at it from, talking about it from the IG point of view, there's two perspectives I can offer. So IG Group as a whole is a global CFD provider that's got a footprint across 18 different regulated entities across the world. So we've got worldwide footprint, so people are doing different things at different times in the economy. So the pandemic hit different places at different times. So you have a kind of a little bit more even out scale. Also, different people are interested in different asset classes in different countries, so you have that evens out as well. And then from the Brightpool point of view, Brightpool is a market maker that provides liquidity onto the Spectrum Exchange and other MTFs. And we have a very different product to CFDs. We have a turbo product, which is like fully collateralized security, basically. And we're at a different state. That's a relatively new business, so we have only been going a couple of years, and we don't have equities. So we saw very liquid products, but we've seen lots of trading across that. It's focused on Europe. And that's all I want.
I mean, for me, I kind of agree with everyone, and especially with Benjamin. It's mainly the scalability, and I see the way that COVID affected us and the new waves that are coming in is just we have to always think about scalability. This is the key word now, and as much as possible, whenever we approach a new business or a new idea in the company, the first thing we think of is, can we scale this X 100 billion, 10 billion? Because the waves that are coming now into the market, whether in the crypto space, in the fractional share space, you need scalability. We're inviting a huge number of investors that we've never seen before in the FX and the CFD space. When it comes into the B2B space, and not just to stay focused on the retail and liquidity provider, it's not just aggregating the liquidity. It's not the keyword anymore. It's more about also what's happening with the Robinhoods and the payment for order flows, and about building our infrastructures and systems and processes to be more also adaptable to the new changes in that space, and being able to kind of adapt our risk management tools and customize it to be able to take that type of flow and monetize it in a way that, because as Johnny said, a lot of the brokers that were not able to take risk anymore, and they were actually losing money in the last couple of months when the volatility started to come down. So in the prime brokerage space and the prime of prime space also, we need to be able to kind of to innovate and manage that on the back of the retail flow that's coming in and increased in the last couple of months.
Thank you, Mohammad. Marc.
Well, first of all, the amount of risk you can take as a bank is limited by a lot of rules and regulations, and Basel II and Basel III, and luckily we have some equities, so we can take the risk that our balance sheet and our equity is permitting. But I think that's a sound system. It's I'm always a little bit surprised when I hear we're a broker, we can't take more risk, we have to de-risk, but this is not the way the system should work. The way the system should work is that what you can provide as a service to your clients is exempt of risks. And that's very much what was a challenge in this year, especially with the super high volume we had in the beginning, and now the volatility is flattening out a little bit, and you have to make sure that the business model you're providing is sustainable and brings value to your clients. So I think the key words here is the strengths of your business model, how strong you are, the transparency you can provide to your clients. They have to understand the business model. You all remember what happens with payment for order flow and the Robinhood app, when suddenly the clients realize that actually they're not the clients of Robinhood. The real clients of Robinhood are the hedge funds that are buying the order flow. And there was some kind of a wake-up call. It didn't last very long because, the trading behavior and the volatility is coming back, so you have to be active on the market. But it was very interesting to see that suddenly a business model can turn very easily. Suddenly the clients say, hey, is the provider I'm dealing with and where I put my assets, does he has my best interests in mind when he's doing business with me? And I think that will guide the behavior hopefully of the industry for the next year.
Thank you, Marc. Yes, indeed. It's actually one of our hot topics to be discussed in this panel, to pick your brains on what happened on the Robinhood, wallstreetbets, and all of these. We'll get to that in a second. But before that, I want to ask Matthew, from a B2B standpoint, has the increased volume in trading reflected into a higher demand for white labels or new brokerage setups from IBs or new entrepreneurs that want to launch their own retail business?
So it certainly has, yes. We've seen huge growth in the number of new entrants to the market, and additionally in the incumbents looking to take on extra products, looking for extra market depth and extra capacity within their own business. And interestingly, what we see is that a lot of those are coming for a full scope offering. They're not just after liquidity, they're not just after CRM. What they really want is front-to-back solution. And if you're able to provide that, you end up with a pretty sticky customer, someone that you have a genuine symbiosis with and that you can share with, and that you've got a mutual interest in helping one another's business grow. And I think that's where we've seen a real focus on business development and where we've got some very strong partnerships. And we're able to constantly innovate, and the end retail client is looking for new products. So the proportion of our business that is FX has diminished compared to metals and compared to equity products. Actually, if you've got a big, strong, stable partner that can offer you a front-to-back offering, you can add in that extra opportunity for the client to go and trade and generate income.
If I can jump in quickly on that, because we've seen a huge increase as well, not only on white labels, but I would say any startup broker, because I feel also during the COVID times, our industry has proven to be kind of the most lucrative businesses out there. So there's an attraction for capital, whether from inside the industry or from outside. People are
Opportunity finding.
Opportunities as well. So investors are putting money into new brokers, whether it's white labels or just a completely different setup. So there is a huge shift in capital going to online business, and probably our industry was one of the main kind of shining one during the COVID times. So yeah, we've seen a major increase in demand on that side as well.
I have possibly a slightly, slightly different perspective on the multi-asset thing. I think yes, a fair few brokers retail brokers have engaged in kind of I've got 1,001 products, whereas my next competitor's got 1,000 products, kind of arms race, and that's a very, very easy wild goose to chase because, but ultimately I'd be actually astonished if there is any retail broker in this room that has really kind of made particularly meaningful money in the, let's say, the non-core assets. It's a lot of institutional players, because they have multi-asset, will sort of stand here and say, that's the future. And particularly, obviously, with MT5 being having more assets or certainly more symbols available within it, it has been a sort of focus for a large amount of retail brokers. But our very strong and very consistent observation is that actually retail brokers are making all of their money and doing all of their flow in FX, indices, and commodities. And we'll see how we'll see how everyone does in crypto as people sort of start to move into that product set. But there's a rational there's a rationality behind sort of going after or providing a huge amount of additional products. But if it becomes takes up a significant amount of your cost and a significant amount of your infrastructure, I would just caution a lot of the retail brokers to actually look at whether the return on that cost is actually proving to be quite what they had hoped it was going to be.
It's a marketing tool, though, right? It's a way to stand out and make yourself different from all brokers that pretty much look alike. How do you stand out from your competitors? Do you have one extra product? Do you have one different PIP?
But having one extra product that no one trades is your head of marketing thinks it's a great marketing tool, but it doesn't actually generate any business. So I'm sure that probably the other people on the panel, in fact, will probably universally disagree with me on that point. But
I think Matt has is eager to answer that one.
I think certainly some of these more esoteric products or pairs are never going to take over the world, but it's partly a marketing tool, it's partly brand presence, and as Benjamin highlighted, if you've got a scalable product base and scalable business, so you pick up a greater share of the client wallet. The more you can offer them, the more the collateral is placed with one partner rather than being across a diverse bunch of partners. Efficiencies for everybody, and it helps you scale your business. It's very much my firm view is that the more you can offer people, so you're greater the opportunity to pick up business.
I think it's a red herring.
It's two different
Very much on your own here, Johnny, I think.
Yeah, I would disagree a bit. I mean, it starts from the client, right? So he has a product he wants to trade, and it's not necessarily because your marketing or your business model is pushing your own product, then the client doesn't have a genuine interest in trading his own product. So we are actually on the other side of we are listening to our clients, saying, what would you like to trade? So, you would like to add this market, this type of product. He wants to trade fixed income, bonds, equities, and you have to provide it, because that's the way you keep the clients loyal and happy with your service providing. So for us, and especially in 2021, it made a real difference because all the markets were super active. Remember, what happens in the beginning of the year, you had this incredible swing, and then equity was trading really, really good. So you had to be there. And I think there was one of the questions, sorry to anticipate that a little bit, was to say, where, who got most of this incredible year in terms of revenue. I would say is the one that would offer a large palette of products.
Yeah, I would also agree here with this. I mean, I have to make a bold statement that I think that 99% of our industry all look the same, and it's getting boring. And I'm not from the industry from before. I come from e-commerce, right? And when I saw all of the brokers, I don't want to insult anyone, but if I start just trading with a chart and
we like it polemic, don't worry.
People told me something about multi-assets. I, as a retail client, I don't understand it. I mean, I want something that reminds me of Instagram or Facebook. I want video, I want motion. I want people to educate me visually of how to start the markets and trade the markets, right? And I admire the offerings and all the technicalities, but for the retail clients, so that's why Robinhood worked so well. No matter what people say about Robinhood, it's a massive success. Of course, they had the issues with the business model. I think a B-book is also nothing to be proud of, to be honest, so we should not be, very critical to Robinhood for PFOF. But I think that the clients of the future now, in the next decade, they will not like to be reminded of a brokerage platform. They want something different. That's what we've seen. We, for example, grew in Q1 21 stronger than before, in Q2, in Q3 even stronger, so we're growing all through. And I think the magic thing is to change the usability, change the user experience, remind the people more to be like the apps that they use. Don't ask them for a huge form of sign up, just let them sign up with a phone number, get them in via videos, get them in via snappy content, and then introduce them to trading and assets. That's why crypto works so well, because influencers are talking about crypto, they get into it and you can make money with it. So I just think that the offering and the usability is driving now the customers of this decade. And if you miss that, you'll have no business and you'll be reactive as most of the brokers because they just wait for volatility. Everyone is screaming how successful they were in 2020, but 2019 was really bad, right? Because everyone will tell you there was no volatility. So what are you going to do about it? Just wait for volatility? Then you don't have a scalable business model and you don't have something that is attractive to investors, right? Our company is worth now 400 million on the exchange and we're just a broker, you would say. No, we are valued a lot and most valued more than a lot of businesses. They're much bigger than us because we sell something that people want to see what's the future, and that's not to look like a broker. And assets you have to offer anyways. People will always look for one platform that offers everything instead of having 5 KYCs and 5 apps for the same thing. So that's just my take on that. And I treat the financial industry like an e-commerce shop. And I think that's what people should do more in the industry as well.
Thank you, Ben.
If I can I challenge can you define what you consider our industry with 99 point whatever % of it you think looks the same?
Yeah, mostly self-directed trading, brokerage platforms where you sign up and you just see a chart and price blinking, and then somebody might call you or somebody sells you a webinar, or that's it. That's for me the industry. I mean, this is how I started in the industry, and I thought that's not attractive. I mean, I want to have something that is simple and from the usability super snappy, animated with GIFs, and not I mean, if I look at the interfaces, even if you go into the booth, everything looks the same. Everything. I mean, this is not how it should be. I think that if we, innovate a bit more visually, then we'll be more successful as a whole industry.
I agree. But do you include? Would you include Robinhood as being part of our industry?
No, Robinhood has disrupted everything because they made everything much simpler. And if you use the Robinhood app, you'll be amazed how every single button and every step in the process, from the KYC to trading, how it excites you, and how of course people say it's too simple, etc. But that's what people want. Why people go to TikTok to consume content in 15 seconds rather than reading a book? Because that's where we are. The awareness of the clients and the attention span is reduced. So we have to go there. That's my belief. That's how I look at the market.
I hope that everybody's taking notes. This is from a Forbes 30 under 30. We're going to jump right into Robinhood, actually, because it's the topic that keeps coming about, so let's just head right into it. So what are the lessons that we learned from the Wall Street bets, the payment for order flow, and the Robinhood conundrums? Because Robinhood, right before it went into valuation, according to regulatory fillings, it was worth 18 million active users ahead of its public debut. So a research paper by the Swiss Finance Institute reported that despite holding only about 0.2% aggregate US market share, Robinhood traders drove above 10% of the variation in returns from stocks in the second quarter of 2020. That's because they say that that's because they buy and sell more than the institutional counterparts in response to price changes. Is this a social movement? What does that have to do with the points that Ben is making about the attractiveness of the platform, the ease of it, a different type of investor profile that they're attracting? What are your takes as leaders of the industry on this? Who wants to take it first?
Well,
Marc.
First, I mean, it's the model that works in the US, right? Because to resell an order flow, you need to have someone that buys the order flow. So don't forget, the business model of Robinhood, of course, they need the clients because they need the volumes, but their main business model is to resell the flow to the industry, the hedge fund. So first of all, you need to have someone that wants to buy your flow, and it's working. The more concentrated the flow is, the better it's working. So that's also probably, you say, it's a reduced set of products they offer because that's their interest, right? In Europe, it's a little bit more complicated. First of all, because the regulator is still having a look at payment for order flow. It's not finished yet. They're thinking about further regulating the market. There's always already in MiFID there are two very important things. The first one is the pricing needs to be attractive, and then when you resell your flow to someone else, there must be a continuous advantage for the clients actually, and the continuous advantage cannot be just the fact that it's at zero commission. So this makes this type of business for Europe super difficult. This probably also explains why Robinhood finally decided to leave the European continent. Maybe they're coming back, but I mean the regulations is making that business difficult. However, I would totally support what you're saying. The big advantage of Robinhood, it's very super simple. It's very appealing to clients. Trade with a button. It's nicely made. It's everyone that had the Robinhood experience, wants to say, okay, my application should look like at least part for what we're offering, and this is a real change. However, we have to adapt this to our European reality.
Yeah, I think that model is a fact now. Everybody likes it. The Robinhood, all these new social platforms. Everyone likes it. It's not going to go away. And as Benjamin said, our industry has been extremely dull in terms of innovating, and not only on the client side as well, but also on the back office side. So we're talking about payment for order flow. I'm one of the people who really support this, and I know that the regulation now, FCA and MiFID, kind of in general, they're writing a lot of articles, maybe a few things that we have to be limited in terms of where we're going with this model. But I think I've seen a lot of new, let's say, in the industry, in the FX and the CFD space, a lot of brokers and companies, whether on the prime brokerage side, on the prime side, that are investing heavily in this, because it takes a big edge out of the retail client, takes a big edge out of the retail broker as well. So on the other end of the spectrum, we need professional people to be able to handle all these sorts of flow while still giving the value to the client and to the retail broker. I believe in that the industry is going to have to move into that direction, whether on the client side and being more creative as social platforms, and just stay away from the platforms that we've been dealing with in the FX and CFD space for the past 20-25 years. Everyone needs to adapt, and on the risk management side as well, and on the sending the orders to the street as well, we need to adapt, and we need to create as much as Robinhood and these guys did as well.
I think with the Robinhood story, so we've had a few comments that Robinhood is sort of very much part of our industry. I find myself again in a situation where I don't altogether agree with that. I think Robinhood, the US equities is a massively fragmented market. The liquidity sort of characteristics of US equities are enormously different to sort of the core products of of all of the businesses that trade here. Comparing Robinhood to a predominantly MT4 retail broker is, as far as I'm concerned, very similar to comparing Revolut to an MT4 based retail broker. I think it's just broadly a red herring. I think the payment for order flow question is a very interesting subject. I mean, obviously, it raises some ethical problems or some ethical questions. I think a lot of that is dealt with by disclosure to the end clients. And then I think at the institutional level, obviously, there are players in our space that are offering revenue shares, payment for order flow. There are a few ethical questions related to that. Imagine rehedging costs, which a lot of the institutional players are using to kind of effectively as a risk management tool, which is ethically questionable and possibly legally questionable. Basically saying to your client that you're in a partnership with, the hedging costs for the previous month were whatever your account manager feels they can get you to stomach is not really a partnership, is not really a proper relationship. We've been working a lot on risk partnerships. We've recently released or gone live with a couple of full book share risk partnerships with a couple of clients, consistently delivering positive revenue month on month, consistently beating client drop. That's obviously somewhat market dependent because the volatility hasn't been sort of necessarily significant, but there's payment for order flow and there's payment for order flow. And I don't think as an industry necessarily, I don't think the institutional players necessarily are actually really operating in let's say the revenue share, to use the old-fashioned the old-fashioned phrase, sort of environment in necessarily a particularly above board way, and really being properly transparent to their clients about things like hedging costs, for example.
I'll just pick up on a couple of those points, Johnny. So I think one I agree 100%, the other I don't agree at all. Robinhood is absolutely part of our industry. It's 100% here to stay. The customer is king. If the customer wants to invest in FX...
it wasn't here to stay.
Yeah, it's not part of our industry. It's part of our customer base. If the customer who is king wants to invest in FX, invest in FX. If they want to invest in equities, invest in equities. It's all part of the same wallet. It's all part of the customer's investable income. And I think it's a very, very broad view of the industry if we say it's just leveraged FX, that's all it is. So we disagree on that one. But the one way we do agree, I think, is that on revenue share deals, on partner deals, transparency is absolutely imperative. And sitting down, talking partners through the numbers in real time, explaining why certain actions have been taken is critical. It's all about honesty. And actually you can take that then further down the chain to say if you disclose to a retail customer that there's an element of payment for order flow in their business, customers aren't stupid. They understand that they've got to pay for the platform, the service somehow. That either comes through a commission or does it come through payment for order flow. But it's about transparency, honesty and integrity with the customer.
That's why I think the regulation is going to, I think we're going to use that model anyway, that the regulation is just going to try and add as much transparency as possible to that kind of model. And then,
absolutely.
Mm-hmm. Yes, but I agree, but it has to be transparent. Remember what happened with GameStop. Yeah. They stopped the trading in GameStop, and then the suspicious came. Are they doing this because they have technical issues or whatsoever, because they can't handle the volume, or are they pleasing their end clients, the hedge fund that doesn't want to take the order or the flow any longer? So that's where the model has to improve. That's where the transparency to the clients has to be optimal. And if there's something you can object to Robinhood, would be this part. I mean, and that's what happens in the US now. It didn't went really far because next day trading is coming, but that was a debate at least.
Yeah.
So I think it raises an important point about education as well, and what our product set is. And I think I sit on a different spectrum of what our industry represents and what our products are for me. But I think we have a responsibility as a financial community to be responsible in the products we're providing to clients, how and when we provide them. So you talk about GameStop, for example. Certain firms slowed down access for retail clients to get hold of those shares. What shares were they trading? Why were they trading them? Do they understand what they're trading? Do they understand what's going on behind the scenes? So I think it's really important that we consider our product set to be not only getting clients to trade an FX derivative product. I think we're in a bigger industry of financially educating people. I don't know if we're going to come to it, if we're going to have time, but the democratization of our products to the world is important, and we're responsible about the way we put them forward to people. And it's got to be key that responsibility is shared by not only us as brokers, other institutions, the clients themselves. But we've got to provide them products, and we've got to provide them products that aren't only trading products or simpler products and education to go with it.
Yeah, I fully agree here. We have to be a bit more empathic with the clients because, once again, a lot of people don't understand what is trading, but they're interested. We've seen it with Robinhood, and I want to also just have one thinking point here. We talk so much about Robinhood, but I have colleagues running Trade Republic in Germany. I don't know if you're aware of Trade Republic, but if you just think that's an US phenomenon, it's not true. Trade Republic, we started together, and they are like a 4.7 billion valuation and raised 900 million from Sequoia. They don't just do equity trading. Why they're so successful, why they are one of the fastest growing fintechs in the world is, again, because they made it exciting. It's PFOF, not PFOF. They do it a bit differently, obviously. They're just forwarding the orders. But once again, this is another proof that the industry has to make the product more exciting, more educating, and simpler. And the train will go, and it will go so fast that this industry in 5 years will be, maybe the conference will not be as big as now, because you need to be much simpler, you need to think differently now. And I love the example of Trade Republic to show, even if you just replicate the UX of Robinhood in Europe, where people think it's not possible, suddenly you boost your valuation by 50 times in 12 months. Is that just a mistake? Or are the VCs just too bullish, or are they headless? I don't think so. And if you ask me how Robinhood enters the market in Europe, they do it via companies like Trade Republic, right? So, or companies that like us. So I think that's the core that we have to make it a bit more exciting. I fully agree. Transparency is key. And I think there's a lack of transparency still in the industry, and we have to think for the customers as well. The same way as they would purchase an item on Amazon, the same way they have to, be able to just trade the markets with us.
Okay. Thank you.
Yeah, well, valuation is one thing. Successful business model is another thing.
They're very successful.
Look, take Revolut for example. They're massively successful. They valued at billions, but they still loss making. So
like Amazon for 20 years.
Exactly.
Now everyone owns Amazon.
And like WeWork.
I just want to say, it's not because you participating in an exciting moment where fintechs are valued at crazy numbers still, that your business model is successful. So you have to innovate, and just having a nice user interface and selling your products for zero is, for me, not necessarily innovation. You have to go one step further, because that's very easy models to replicate. You could add.
I mean, if it's so easy, why? I mean, just to make profits all the time, it's great, but you need user base and adoption and mass adoption, and you will be a market leader in your country. That's it, or you will have some business. But if you want to really be huge, and if you want to capture the entire market space or regions, then you need to think VC. That's my view, obviously. And Revolut will be super successful. You will see they just turn the button and make money, that they're growing. The same way as Amazon and all the other big projects that people are saying, or Tesla. Suddenly, after 5 years, everyone's running around Tesla, right? How many people were saying that's bullshit? And the same way, I think that this attitude is very important for our industry, because it disrupts the thinking pattern completely. But I agree, of course, you have to make some money, or you have to have strong financial partners in the back that will fund the growth until you turn it profitable. But they will turn it profitable.
When you're a bank, you have to make money. That's the problem.
Maybe you should join something more exciting.
I don't think any of our clients would accept that we are loss making. That's probably the difference. But I agree with many things you say. The innovation, the companies that are changing the way we consume our products, they have an advantage. They have to keep the advantage. That's what I say. Will Tesla still be valued 1,000 billion in 10 years? More has to be proven.
As interesting as the discussion is, guys, I'm so sorry. We need to cut it here because we have 7 minutes left, and we didn't get to the Q&A of the audience. I'm sure they're full of questions as well. So I'm just going to ask one last one. I'm going to combine the last two. What revenue streams will shape 2022, and what are your top concerns for the near future? If you could just keep it short, I would appreciate it.
So I think a top concern, a top challenge for our industry is the global war on talent. Yeah, we recruit top-tier people all around the world. Finding those people is not always easy. Keeping them, retaining them, give them interesting, challenging jobs that grow them professionally and personally is a challenge that we all face. And it's not just within the narrow confines of our regulated businesses here, it's across the entire fintech financial services world.
Thank you.
And I want to agree with Matt as well. That was very similar to my point, because I think finding the talent, keeping the talent, and it was a seamless transition, getting people from the office back to home during the COVID. I don't know how seamless it's going to be taking them back from home to office now, because we adopt a hybrid model, yes, but we're big believers in kind of the office culture and the camaraderie that creates between employees. And it seems like now employees would probably go just to find the place that give them more flexibility and so on and so forth. So that's one of the concerns that I think we have for the upcoming period.
I think it's speed of execution as well, because we live in a very good time. As mentioned, the excitement is a lot in fintech. We, for example, we secured funding from Peter Thiel, for example, right? These guys are pushing a lot, and you need to be there, and you need to be scalable. So I think that's the biggest challenge, because now we are at the moment where we have a lot of demand. It will be there. It will be in waves, of course, but I think the biggest challenge is really to keep building a scalable system. And the concern, I don't have any concerns at the moment, at least, so let's see how it will go over the time.
I think one of our biggest concerns is that there can be a little bit of a case in this industry of people having sometimes a fairly short memory. So we've had a period of relatively low volatility. I think it's pretty well publicized. There are some fairly serious macroeconomic headwinds coming. We've come out and said that sort of the SMB activity is looking relatively similar to what it looked like a few years ago. And so I think there's some concern about potentially some 5-10 standard deviation events coming in the near future, and is the broader industry as a whole really prepared for the next shock?
Thank you.
I'm thinking more about the product set that we offer, and I don't think it's anything new. It's I think the big product that has still not been unpacked properly is crypto and crypto cash, and what we can do with that and how it's regulated. We heard from Sisek earlier about
Mr. George Theocharidis just said that a couple of weeks ago they just came out with the new rules and everything.
But that story hasn't played out. I think that's still to come over the next couple of years in a wider, cleaner, more useful remit.
Thank you. Marc?
What keeps me up at night is to anticipate the next big event. Our industry has the tendency to forget a little bit the past. But probably if we would have that panel discussion back in February, March, when the markets dropped so massively, then probably we would have a different story. So what can happen in 2022? Well, there could be absolutely a drop in markets of 20-30%. That's built in,
That's optimistic.
Yeah, you have to be ready for those events. You have to be ready that your business model actually sustaining this type of extreme events, and there will be extreme events to come.
Thank you all of you. This has been a wonderful discussion. I'm sure we can take it after as well and keep discussing, because there has been so many amazing topics and very good takes. I hope the audience actually got actionable items and very interesting insights. We're going to open the floor for 1 or 2 questions, if I'm allowed. One question up there.
Hi, what has proven to be your most successful marketing strategy over the last...
Sorry, we can't hear you.
Marketing strategy over the last year?
The most successful marketing strategy over the last year.
And just to add something to that, and how do you market whilst at the same time not stay within the compliance limits of not being aggressive?
I guess that comes following the speech of the chairman of Sisek saying against aggressive marketing practices.
I think, in our case, I can just say we market more about how to get started in the market, to follow people. We have a copy trading model as well that work very well, because a lot of people, if you look how they educate themselves financially at the moment about financial education is on TikTok, Instagram, and YouTube. They don't read ebooks, they don't read research papers, they follow some influencer, right? And I think the people pitch works very well if you offer it as well as a product. So in our case, instead of saying trade at best execution, 0.5 milliseconds, all these boring things, we said like follow the best people. Yeah. So and that works very well in the world where you have not only influencers but finfluencers, yeah, financial influencers. And I think and education in general, people are very hungry to understand what's going on because there are a lot of question marks, especially during the pandemic, what will be affected and how does it work? And suddenly people were thinking about oil and gold and Bitcoin and how does it all correlate? I think the educational pitch is also, and it's in line with regulatory a lot, so you're naturally not aggressive because you help people to understand and then you offer the product.
I think
Anybody else?
To pick up on another topic, there's been a few mentions of the word boring. Doing core business really well and making a load of money, I don't find that boring, personally. Chasing the next butterfly, that may be exciting, but rarely pays bills.
My butterfly is making money, so I'm happy. I'm not losing money with my company.
It's not boring for you, Johnny. It's boring for the client. We're trying to make it interesting for the client. For us, it's not boring. I agree.
We'll take a poll at Finance Magnates on what's boring and what's exciting for the audience. Take that. Anybody else wants to take on the question?
I think a very successful marketing strategy for us has been to talk about the full-scale offering. You instantly get scalability if you partner with someone that is big and can offer you CRM, liquidity, risk management, onboarding, payments, the whole lot. You don't need to go to 20 different places. You really can grow very quickly.
I'll just do a quick one on channels. So I think going back to education that we were talking about, social is great for getting education out there, but also running content channels like your own TV studios and like producing things has been really important as a channel. And also for us particularly, search engine optimization has been a key one because you're just out there everywhere and letting the technology bring clients to you, basically.
Yeah, and for me as well, multi-asset, more relatable products in the marketing is much more appealing than just FX and CFDs. Netflix and Amazon stocks is much more attractive than euro or oil or stuff like that. So being multi-asset and targeting the more relatable items as well.
Mm-hmm. Okay, our time is up, but Jenny is here. Yeah, one more question? Yes. Okay, one more question. No? No brave souls? Okay, then I guess we're up. Thank you so much, everyone. Give a big round of applause to our speakers.